BNY is a sponsor of our event, so thank you for that.
Happy to be.
We were just kind of getting ready in the back and just saying just so much going on in this first quarter, to say the least, right? I just want to throw out some statistics, if I may. More than $3 trillion erased from bond and equity values during that first quarter. We had the S&P peak to trough slide about 13% at its worst. NASDAQ and Russell 2000, we saw bear market declines of 20%. Crude, huge swings. Bitcoin, nickel. You know, unless you were kind of in the commodity space, you did really. It was a rough quarter. So volatility. So Catherine, let me start with you. How did you see the first quarter? Like, how do you kind of sum it up?
Yeah, so volatility obviously is driven by uncertainty, and I think it's fair to say that with the worst global health crisis in 100 years, with the first serious ground war in Europe in 80 years, with the worst inflation in 40 years, and the tightest labor market any of us, I think, have ever seen, there's a lot of uncertainty out there. And so, you know, you focus on what you think will guide you going forward. And so what do we really focus on? We focus first and foremost on inflation and interest rates. Interest rates are the foundation for valuing all financial assets. We focus clearly on geopolitics. We did not anticipate this event in February. Normally, a geopolitical event, markets tend to respond, tend to go down and then rebound very quickly. That's what happened after 9/11. And actually, you did see the market bounce. It was a tough quarter, but it was a better March than February. We look at confidence, right? Because what causes recessions? It's behavior. So we look at CEO confidence, consumer confidence, and we see that in a relatively mid to high range, but coming down. So we watch that. And then the last thing we look for, and you sort of hinted at it with commodity markets, is we look for where could there be leverage in the system. When Russia defaulted in 1998, there was leverage in the system. It turned out it was leveraged currency bets. In 2008, there was leverage in the system. It turned out that it was in mortgages. Do we see that kind of leverage in the system? Not necessarily, but what are we watching closely? To your comments, commodities. Commodities. And leverage matters because that's what tends to lead to a more dramatic decline.
Right. So Lynn, come on in on this, the volatility that we saw in the first quarter.
Yeah, I mean, someone new to her seat. It was a really volatile time to take this seat. And I mean, I look at it from just the intraday swings, the day-on-day swings, and then I also look at it from the perspective of messaging that's hitting our platform. I mean, we had our top 5 messaging days ever happen this past quarter. Right. And you're talking about 500 billion messages a day that we processed across all of our platforms, which is unbelievable when you think about it. And when you really saw that was when you saw, the 1,100 point swings intraday in the S&P or some of the other markets. It feels as though the market, though, is starting to come to grips with the volatility. They're starting to take a position that perhaps the Fed is going to do what it's been telegraphing it's going to do. I think maybe the Fed raising a quarter basis points in March gave the market a bit of confidence to trust what was being forecasted there. So we do see volatility starting to abate.
Right.
And from my perspective, I have to look at it from 2 different perspectives. I got to look at it from our markets, but I also have to look at it from the IPO pipeline.
How's that going?
Yeah, and volatility, as you can imagine, when there's a lot of uncertainty in markets, volatility is going to weigh on those companies who are looking to go public because, they're a bit cautious about bringing their companies to market at a time when they can have these huge intraday and day-on-day swings. A big indicator that the CEOs that I'm talking to who are planning to come to market, that they're looking at is the VIX and how that is starting to behave. When you see it go below 20, that's when the CEOs that are in our pipeline are like, yeah, maybe I can now start to think about coming to market.
And we ended the quarter just around 20.
Correct.
Right.
I think a couple of weeks ago was the first time that we saw it dip below. So having a lot of conversations with those companies that we know are part of our pipeline.
One thing I thought about in terms of the first quarter, there's volatility and then there's chaos, right? We've seen chaos in the financial markets. I mean, let's go back to the financial crisis and other times where you really felt like, oh my God, the system is coming undone. It's an important distinction because I think about the exchange. It functioned, right?
Absolutely. And I think about 2 years ago, in particular, when you had the pandemic, when we triggered in the US equity markets the market-wide circuit breakers, which are a halt when the S&P dips below 7%, and then reopens, and then further dips. We had to halt the market 4 times during that period. We haven't had to halt the market. This is just the market finding its footing. And you know, our job as an infrastructure provider, as a marketplace, is during times like this, we need to remain open, we need to have orderly trading, we need to have efficient trading, because we need buyers to meet sellers, sellers to meet buyers, and to do so in an efficient fashion.
We say it a lot, but markets go up and down. Catherine, come on in on this, because I do wonder, like, was all of a sudden everybody, again, getting to this point of chaos versus volatility, were all the clients at BNY Mellon, you know, calling up and saying, I want cash only?
No, and in fact, what you see is that there wasn't chaos in the markets. It was actually a very interesting kind of leveling quarter, because it almost didn't matter whether you are 100% in stocks, the S&P 500, or 100% in bonds. Your portfolio probably lost about 5%.
Right.
So that's not chaos. That's
the
normal.
60-40 didn't do so well.
Actually, it was a combination of the two. It did about the same,
Right.
And so what was unusual about the quarter was it was such a tough quarter in the bond market, right? Because you had interest rates rising so quickly, and then you had something that typically doesn't happen. You had spreads widen at a time when the economy is actually doing quite well, right? Spreads usually widen when the economy is not doing well, but you had both of those at a time that you didn't have enough, the rates were so low you didn't have any yield to protect you. So we think that is beginning to start to reverse in this quarter, but everybody's pretty much in the same position at the end of the quarter. Most likely, your portfolios were down about 5%, and given all of these big uncertain issues out there, that's actually a very resilient outcome.
Well, this is what I wanted to ask you about some of the volatility triggers. Like we mentioned them, geopolitical tensions, China versus the US, China versus the world, inflation, inverted yield curves, innovation disrupting itself. You guys have been moving increasingly into whether it's the crypto world, the NFT world. What among what some might consider volatility triggers kind of concern you the most, Catherine?
So it's the things that I mentioned earlier, right? We can't control any of these things, but I think that there is a path to a soft landing from all of this, and the path probably includes a couple of things. Obviously, it's the Fed tightening rates, but not too much. It is companies doing what companies do, which is managing through this uncertainty. We have, company profit margins at all-time highs. We've seen a tremendous spike in productivity over the pandemic. That helps corporate results. And we need consumers to do what consumers do. And there's an expression, high prices are the cure for high prices to a certain extent. And what we need the consumers to do is shift a bit how they've been spending, which is on goods, right? All the things that people did to work from home and renovate their homes and all of that, and shift a little bit to services. And then I think there is a path to a soft landing from this.
Yeah, I would agree with that. This is not the first time there has been volatility, to your point earlier, in markets and uncertainty in markets. And markets are resilient. And our markets in the US are the envy of global markets, given the access, given the investor protections they provide, given the types of companies and the transparency that those companies provide when they are public.
Right.
So we've been here before. And we've been here under less of a crisis, if you will. This is not the financial crisis. It's not, the start of the pandemic when there was a tremendous amount of uncertainty.
Feel uncomfortable.
Yeah, it did.
And volatility doesn't necessarily mean negative returns, right? The average intra-year correction of the S&P 500 over since the 1980s is about 14%. And yet, so 14% dip at some point in the year, and yet 75% of the time, the market ends up. Rising interest rates does not necessarily mean negative market returns. It
Right.
might mean lower market returns, but if we look at the, sort of 10 rate hiking cycles since the 1960s, 8 of them have actually had positive returns,
Right.
including the most recent.
And typically often means the economy getting back to normal. One thing I want to ask you, though, when we talk about like inflation, there is a generation of investors that don't necessarily understand high inflation or 17%
We're all
mortgage
calling our
rates.
parents,
Yeah,
yeah. We're all
exactly.
calling our
We did actually a Twitter poll, and I want to bring it up for everybody because we asked on inflation, can the U.S. return to 2% inflation without a recession? And as you can see from the results, an overwhelmingly response of no, almost 71%. Do you all agree with that? Yes. Do you agree with that? Lynn, do you agree with that?
It's interesting how sentiment tends to drive markets, though, too. And I think that is a new phenomena that you've seen with social media and how that perception may be driving different things in markets, different market behavior, as opposed to fundamentals of market. I always come back to fundamentals of economies, and does the economy have a capacity for growth? And this economy does have a capacity for growth. However, sentiment has become a very important driver of what you see in markets.
But to your poll, I would ask a different question, which is, do we have to? Do we have to revert to 2% inflation? And we don't actually think that we do. For most of our, investing lifetimes, we had 3 to 4% inflation a year and markets did just fine. We've always thought that inflation wasn't transitory, it's transitional, and it's transitional to a new normal that'll be a bit higher than what we've had since the financial crisis. But that 3 to 4% inflation, markets can do just fine. Businesses can raise prices. They can raise wages a little bit. Consumers can buy a little more.
Wouldn't be bad for a lot of workers to get some higher wages, right?
It can do just fine. And to your point, you're exactly right. It's the economic ecosystem that all of this happens in that matters. And we've just come through an extraordinary time, right? We had 55% of the global economy closing down in a single month, and the fastest and steepest decline ever, and yet roaring back thanks to all the stimulus that our government and governments around the world provided. And so we actually came out of this recession for the first time ever with no income loss. What normally happens in a recession? People's incomes go down. Not any quintile of income earner in this country had their incomes go down during this recession. So the economic ecosystem is very strong. Corporate America is very strong, all-time high profit margins, and growing productivity, which is also something that didn't really happen over the last 20 years. And so there is capacity, I think, for growth here.
And to your point earlier, jobs. Think about how many of us in corporate America are looking to fill jobs. It's a hot employment market.
That's right.
That doesn't necessarily feel like a market that's going to head into a recession.
It's interesting that you said it because we talk so much about the inversion of the yield curve right now, and everybody says, okay, that's recession. Well, maybe we need to think about what causes, what's the root of a recession? And we right now have a strong labor market. You talk about earnings growth. There's a lot of things, strong balance sheets, whether it's the corporate world or households. One thing I do want to do, let's ask your question. Do we need to go back to 2% inflation in your view? Yes. Raise your hand. No. So there you go. Okay, that's interesting. All right. So then let's think about some other, so the outlook then, do you anticipate there's more volatility? Like, is there something going on? I mean, there's a lot going on. But I do think about, I know in our planning call, we talked about things like, of course, what's going on geopolitically.
Yeah.
Nobody really thought about that late last year.
Yep.
The energy market, you're seeing how people are rethinking how they do things. Supply chains, we just had a CEO on, moving stuff from Asia increasingly to Latin America. So are there some major things going on that are going to, or technology, I think about, Lynn, that are going to create bouts of volatility within our financial market?
I think that volatility is something.
Read it already, Robinhood has done it.
I think volatility is going to be something that markets live with in general, because markets go through transitions. Businesses go through transitions. They always have. It's just the electronic marketplaces that we operate today just react a bit differently to those transitions. You mentioned energy. We're in the process of going through a transition to cleaner, greener energy. That's going to cause probably some volatility around energy and oil prices for some time. And that's probably okay, because at the end of the day, we're going to move to a cleaner, greener energy future. So I think coming to grips with the fact that there will be some volatility in markets, and volatility is just part of transitions of economies, as opposed to always thinking volatility is bad.
Right.
I think that's probably the right way for the investor to think about these markets.
That's right, and absent a real risk of a recession, volatility and downward shifts in the market have proven to be buying opportunities over the years. So you have to ask yourself, how likely do we think it is that there'll be a recession in the US this year? And I think most of us would say probably not so likely because of all of the things that we talked about. And there is a lot of support for equity markets right now, right? There's a lot of cash still sitting on the sidelines. The consumer is healthy and spending money. Companies are doing very well. So the risk, I think, of a recession in this country this year is probably pretty low, which means that when you do see that downward volatility, it's actually an opportunity to rebalance your portfolio and get back to the sort of neutral weight that you want to have in equity markets.
Well, that's what I wanted to ask you about your clients, Catherine. Like, what are the questions that they keep peppering you with in terms of their portfolios and what you're either the changes you're making or that you're maybe not?
Yeah, so before I talk about our clients, maybe I talk about, clients broadly, because, we, during our careers, have lived through a dramatic shift in financial markets that's all stemmed by a change in how we save for retirement, right? Our parents' generation, they probably retired with a pension plan and whatever savings they'd accumulated and were working with their wealth manager. For most of us today, that's no longer the case. We're not going to retire with a pension plan. We're going to retire, with our savings, which means that we're responsible for our financial futures and our retirement. And so what we try to say to our clients is, we have to make sure that we have the same institutional disciplines that a chief financial officer or a chief investment officer of a pension plan would have, and we have to have them in wealth management. And what does that mean? It means you kind of need the same policies, right? Every institutional investor has an investment policy statement. Every single one. If you're a pension plan, an endowment, you've got an investment policy statement. And the reason you have it is the policy protects you. It takes the emotion out of what you're doing. So we have investment policy statements for our clients, and that means that when there's a real market decline, as there was in March of 2020, we rebalanced. And that makes a big difference, and it's not what you're seeing the typical retail investor do. In fact, you had asked me that question on Friday, so I looked up the industry flows. So if you start from the beginning of January 2020 through the end of March of this year, right, that 2-year and 1-quarter period, the S&P 500 was up 40%. The bond market, I'll pick municipals because our clients pay taxes, was up about 3%. Inflation was up about 8%. And we look at a proxy for how did retail investors invest. We look at ETF flows and mutual fund flows because they often invest in those categories. And what did the retail investor do during that time? Invested $1 trillion in the bond market. $1 trillion. Municipals or the Barclays Ag, by the way, up around 3% with 8% inflation, so negative real returns. So there was a fear of being back in, while this market had a strong rebound, and that's one of the things that we as the industry have to help our clients with.
And understand. One thing I wanted to ask you, Lynn, we talked about the IPO market, and you're talking to CEOs.
Yeah.
What about the SPAC market, which was on fire earlier last year?
Yeah.
It's been a much tougher space.
Yeah, it's been I'd say everyone coming to market right now is a bit more cautious. The SEC just issued new rulemaking around SPACs, which we're still digesting. It's been a very busy time for the SEC with a variety of rulemakings, so we're still digesting what that means. But, on balance, adding additional transparency we think is a good thing.
Yeah.
And at the end of the day, it's not a surprise to us that yet another way for a company to go public, traditional IPO, direct listing, which is something we pioneered in 2018, and now SPACs have additional rules placed upon it because of the popularity of the vehicle. We still think it's a very, very viable way for a company to come to market. So,
do you think once we get more clarity from the SEC or that we start to see it pick up again?
Yeah, I think we will continue. I think what we'll see is well-governed SPACs continue to come to market. That will be high-quality SPACs. It'll be the types of entities that are known to the market, known institutional investors will continue to come to market that way, and there'll be a lot of great companies that wind up becoming public, transparent companies as a result of business combinations resulting from SPACs. So at the end of the day, we think this is only going to further give another set of rules to this asset class.
I always love watching the startup community, and I feel like in companies coming to public, to me, that's, as you say, a sign of confidence of what's going on in the economy. So what is, and I want to get it from both of you, because I know you watch it as well. I mean, what does it tell you about kind of what's to come later on this year?
Related to SPACs?
And IPOs, and just watching.
You know, the amount of innovation in this economy, look how we just got through the last 2 years, right? None of us are doing anything the same way. We aren't shopping the same way. We aren't, accessing the markets the same way. So there's just been this tremendous surge of innovation, and so we do expect to see, more companies coming to market. When it comes to SPACs specifically, they're a more complicated investment in a way, right? Because on the one hand, it's an IPO.
Yep.
We understand IPOs and going public. But on the other hand, when they, quote, de-SPAC, it's typically acquiring a private equity-backed company and going public. So it has these elements of both an IPO and investing in private equity. Private equity funds have done very well over time, but one reason is that they're diversified, right? They're not a single company. So we look at SPACs as single company investments, often in new companies, but you want to be diversified as an investor.
Can we talk technology?
Yeah.
Can we talk crypto?
Sure.
Can we talk the metaverse?
Sure.
Can we talk NFTs?
Sure.
Can we talk T0?
It's every tech buzzword all in a sentence.
Like we said, there's nothing going on. I know. There's so much. You guys have been making investments, doing patents, filing. How are you thinking about this for the future?
It's an interesting space that we're trying to get smarter around.
We all are, right?
And it's pretty similar to a playbook that we had at ICE back in 2015 when we made a $10 million investment in Coinbase, which we wound up selling after it went public for $1.2 billion. So
Not too bad.
Not too bad a return. If only everyone's portfolio could yield that type of return. I think it's a rapidly evolving space, and there are elements of technology that make processes much more efficient, make them much more transparent, and NFTs and the metaverse and these newer technologies are areas that we want to get smarter about. It's why we put one of our top executives, one of the people that actually started ICE, as the CEO of T0, which is a company we just invested in, because someone that we trust and we know we're going to get a lot smarter about. So it's an area we're watching with great interest.
Well, go ahead.
And I think all of these segments are just examples of the innovation that we've seen over the last 2 years. With NFTs, I find it just fascinating. If you think about the art market, right? Okay, galleries closed, museums closed, can't have in-person auctions, and yet, the market has adapted, and we now have NFTs, and of course, it's early, and there are issues around, trademark and durability and all of that, but it's just an example of this tremendous capacity for innovation in this economy.
But that's, to your point earlier, Catherine, that's where we see the market being able to reward innovation through the IPO market. The amount of companies that are out there are just phenomenal, and they're companies that have changed the world and rapidly evolved and seized the opportunities that the pandemic and us not being connected physically, but the opportunity to be connected virtually. So that's why we tend to be bullish about the IPO market. And remember, 2019 we started the year with the government shutdown. 2020 we had the pandemic. Not a lot of IPOs during either one of those periods of time.
Right.
So some volatility to start this year, from our perspective, is not that dissimilar to what we saw in both of those years. And given our market model, which is focused on blending the humans alongside the technology, we think we're uniquely poised at the New York Stock Exchange to help companies go public in the back part of this year.
And you asked us, what are our clients asking us? Well, as we were emerging from the pandemic, what our clients were asking us, everybody tries to think about history and how you can be informed by history. And we're a historic company, obviously.
Of course.
We've been
Exactly.
I
think we
a little bit of
we
history.
sure
New York
have.
Stock Exchange and Bank of New York Mellon, yes. They would ask us, well, is this going to be like the Roaring 20s, right? We're coming out of a pandemic just like we were a century ago. Is this going to be like the Roaring 20s? Fast forward to the first quarter this year, they say to us, is this going to be like the 1970s? Is it going to be like the 1970s?
Right.
And actually, we would not be surprised if this ended up more like a decade in between, which is the 1950s. Coming out, again, of a terrible global crisis, very indebted governments. And what did you see? You saw that, the greatest generation, forming households, tremendous growth in the economy, innovation, the national highway system, infrastructure investments, all of those things, actually a very good economy. And we see that today. And by the way, we forget how important generations are to the economy and markets.
Yep.
That generation, the post-war generation forming households, very, very good for the economy. Baby boomers, their kids in the 80s and 90s, very good. Now we have the millennials. Now we have the millennials forming households.
Right, who weren't going to buy houses and weren't going to invest, and
but
now they're doing it.
But they are.
All right, so we have about a minute and a half left here. You guys have a lot of optimism. I can feel it, right?
I hope it's realism. I hope it's realism.
No, okay, fair. So
optimistically realistic.
Well, so Lynn, there's a lot of things that could go wrong.
Yeah.
Sorry, who laughed? Who snickered? I heard that. But you know what I mean? So what is the thing that you think we as investors kind of need to really keep on our radar?
I think
there's a list.
New York Stock Exchange turns 230 years old this year. It's been through crises, it's been through wars, it's been through pandemics.
Feels like a war right now, like it's a little loud out there.
Exactly, it's a little loud out there. We have withstood the test of time. And if you think about the US equity market system, the rules that have been developed, the transparency that has been developed, every time there's been a crisis, there's another rulemaking that adds just another layer of transparency or another safeguard. That's taken 200 plus years to develop. We've withstood these before. So I tend to be very optimistic about the fact that our markets have been tried, true, tested through the most tough crises.
And we turned 238 years old this year at my company. So again, together for a long time.
You don't look a day over 237.
I know. Thank you.
You don't look a day over 229. So.
But what do we know? Over this long period, markets tend to gradually rise over time. Time is your biggest asset as an investor. If you have a long time horizon, you may not be rewarded every day, but you will be rewarded over time. If your time horizon is short, that's a little different. Make sure you've got cash and you can, support whatever it is you need. But time is a big asset as an investor.
All right, I'm going to do really quick because I know we have to wrap. So if I had to say one thing that people should watch on the downside or concern, what would it be? Just one thing, quick.
I think the Fed raises, I think, is something to just watch.
I would agree with that because that can cause a recession. And the other thing I would watch, and we're trying to watch carefully, is leverage in the system because that can really cause something, even worse for markets.
All right, you guys, thank you so much. Lynn, Catherine, thank you. Everybody, thank you so much.
Thank you.